Hello, and welcome back to the Deep Dive. It is Friday, February 27th, 2026. And I just got to be honest with you right out of the gate here. Looking at the charts this morning, checking the sentiment on X, it feels a little bit like Groundhog Day.
Oh, it totally does. It's just that same exhausting loop we've been stuck in for weeks now.
Yeah.
The market grinds up, everyone starts posting rocket emojis, we hit that exact same resistance level, and then...
Rejection.
Exactly.
Yeah.
Rejection. Back to square one.
It's like we're Sisyphus pushing this boulder up the hill, and every single time we get close to the top, it just rolls right back down on top of us.
Right.
But here's the thing. While the headlines are out there screaming fear and, everyone is worried about tariffs and wars, we found some research today that suggests this isn't just random noise.
No, not at all.
There is actually a pattern here, a very specific, almost clockwork roadmap.
Yeah, if you zoom out, like way out, past the daily candles and the hourly panic, there is a real structure to this mess. And it points to a very interesting and potentially dangerous setup for the month of March.
And this is the part that really stuck out to me when I was going through the brief. It is not the roadmap the supercycle believers want to hear.
Definitely not. It is a massive reality check. It's cold water for the moon boys.
Yeah.
But, it might be an absolute lifesaver for the pragmatists.
So here's our mission for today's deep dive. We are going to unpack 3 massive stories that paint a picture of where this industry is actually going. First, we're going deep on this midterm year thesis. Why are we chopping sideways? And why might next week be a total trap?
Right. And then we have to talk about trust, or honestly, the complete lack of it right now.
Yeah.
There's a scandal unfolding with a startup called Axiom that is frankly terrifying. We're talking God mode dashboards, insider trading, and a platform basically playing with marked cards against its own users.
Wild stuff. And finally, we're going to look at the Clarity Act. We have been begging for regulatory clarity for years, but the monkey's paw just curled.
It really did.
What if getting clarity means losing the one thing that makes DeFi actually worth using? The stablecoin yields.
It's a classic double-edged sword. You get the rules, but you lose the returns.
So let's just cut through all the emotional noise, the fear, the AI narratives stealing the spotlight, and get to the structural reality. Ready to dive in?
Let's do it.
Okay, let's start with the market pulse. I was reading the daily market overview this morning, and it noted that Bitcoin had a solid 2-day push.
Right.
On the surface, if you just glanced at your phone while grabbing coffee, you'd think, okay, we're moving. This is it. But then sold right back down.
It's the textbook definition of a range-bound market.
Yeah.
If you're looking at a 15-minute chart, it looks like a breakout. But if you zoom out to the daily or the weekly, we are just ping-ponging between the same levels over and over.
Yeah, there's just no follow-through.
None. Every time we try to reclaim a higher price, it gets sold into immediately.
And the sentiment just feels so heavy. It's not just the price action. It feels like the crypto industry has lost its main character energy.
That is a great way to put it. It's a massive drain on mindshare. Because you have to remember, back in 2024 or 2025, crypto was the loud, exciting thing in the room.
The shiny object.
Exactly. And now, AI is sucking all the oxygen out of the room. Plus, you've got looming tariffs, geopolitical tensions spiking. There are a dozen very logical reasons for traders to be risk-averse right now.
So people are looking for a reason to sell rather than a reason to buy.
Right. Confidence is incredibly fragile. At the very first sign of weakness, people aren't buying the dip anymore. They're de-risking. They're fleeing to safety.
But here is where the research from Benjamin Callen comes in. And this was a total aha moment for me. He's analyzing historical data on what he calls midterm years.
This is so important.
Yeah, so we are in 2026. This corresponds directly to the cycle points of 2014, 2018, and 2022.
Right, which is crucial context. Everyone wants every single year to be a bull run, but the 4-year cycle has distinct seasons. The midterm year, which is 2 years after the halving, is historically just messy. It's a hangover year.
So what's the specific pattern? Because Callen points out that in those specific years, Bitcoin consistently formed a low right around now, like in February.
Yes. And that is exactly where we're sitting right now. But here is the very specific roadmap he lays out. After that February low, there's almost always a rally into early March.
Okay, so a rally is coming. That sounds like good news. Why is everyone so gloomy then?
Well, hold on. You have to listen to the entire thesis. He gets very specific on the timing. Historically, this rally often tops out around March 2nd to March 5th.
Wow, that's literally next week.
Yeah.
It is a very tight window.
It is. But here is the trap, and this is what you really need to understand to avoid getting wrecked. Let's say Bitcoin squeezes up to 74,000 or 75,000 next week. Cowen argues that this move still fits the bearish or neutral pattern of a midterm year.
Wait, explain that, because if I see 75K, my brain instantly goes, we're back. New all-time highs incoming, buy everything.
And that's exactly the emotional reaction the market preys on. In a midterm year, a move like that is often a lower high or a double top relative to the macro trend.
Ah, I see.
It's just a relief rally. It clears out the shorts, gets everyone bullish again, and then historically it just bleeds out into April and May.
So these years don't typically produce durable new highs. We aren't going to 100K in March.
Not usually, no. They are years of consolidation. They chop people up. The market spends a lot of time doing absolutely nothing or just slowly bleeding to reset the ledger before the next real accumulation phase.
That is such a crucial distinction. Because if you see green candles next week, the narrative on X will absolutely be the bull run is starting.
Oh, 100%.
But the structural reality might just be this is the scheduled March bounce before the April cool-off.
Precisely. Cowen warns explicitly against chasing narratives right now. The news headlines will try to explain the move. Maybe they'll say it's because of some regulation rumor or a tech update. But the cycle structure suggests it's really just time for a technical bounce, nothing more.
Now, there is another layer to this regarding the stock market, because the common view right now is pretty simple. If stocks go down, crypto goes down. High beta, risk on, all that stuff.
Right, the standard correlation argument. It's been true for a long time. If the S&P sneezes, Bitcoin catches a cold.
But you brought up a counterpoint in the notes about front running, and I found this fascinating. Can you break that down?
Sure. So usually risk assets move together. S&P drops, Bitcoin drops. But sometimes crypto acts as the canary in the coal mine. It is the fastest, most liquid market in the world. It trades 24/7.
So it reacts first.
Exactly. The theory here is that crypto might have already started its correction before equities did. We've been chopping and bleeding for a while now. So even if the stock market continues to drift lower in March or April due to all these recession fears, crypto might effectively front-run the decline and find its bottom earlier.
So we could actually see a decoupling.
It's very possible, and that would be a key signal to watch. If the S&P 500 is dropping 1 or 2%, but Bitcoin starts holding steady or grinding up, that is your signal.
Because the sellers are gone.
Right. It means the crypto market has flushed out the leverage, the sellers are exhausted, and it's ready to move independently.
Okay, so the big takeaway for the market segment is do not chase the green candles next week. If we see a rally to 75K, treat it with extreme suspicion. It might just be the midterm trap.
Patience is the strategy here. Capital preservation is the goal. Don't try to catch falling knives, and definitely don't FOMO into a relief rally thinking it's the start of a super cycle.
All right, let's pivot. We've talked about the cold, hard numbers. Now let's talk about human behavior, or more specifically, the absolute lack of ethics in human behavior.
Yeah, buckle up. This next story is really messy.
We're talking about the biggest story of the week, Zach XBT's investigation into a company called Axiom. Now, for those who don't know, Axiom isn't some guy trading from his mom's basement. This is a trading platform founded in 2024 that generated over $390 million in revenue.
Right, this is a major player, institutional grade, or so they claimed.
Yeah.
And the accusations here are severe. Insider trading, front-running their own users, and just gross misuse of data.
When I read the details of how they allegedly did this, my jaw actually dropped. It wasn't just, oh, I heard a rumor in the break room. It was systemic. It was built right into the software.
It was entirely technical. Zach XBT uncovered that employees allegedly abused internal tools, specifically an internal dashboard to view private wallet activity.
They called it God mode, didn't they?
Essentially, yes. The report says staff could see a user's full wallet list, transaction history, and even wallet nicknames.
That's the part that really gets me. They could search by referral code. So imagine you are a huge influencer or a whale. You sign up for Axiom because you think it's a good platform. You start trading. The employees at Axiom can literally look you up, see what you are buying before you post about it or before the market moves, and then place their own trades.
It is the ultimate uneven playing field. The strategy was so simple. Spot the whale buying a token, buy it first, wait for the whale to promote it publicly or for their volume to kick in, which drives the price up.
And then just dump on them.
Exactly. Sell into that liquidity.
It's literally the house playing with marked cards.
Yeah.
You're sitting at the poker table, and the dealer knows exactly what you're holding.
It is, and it's worse than that. The Zach XBT mentioned audio recordings, actual voice logs where employees discuss this openly. They weren't even whispering about it. It highlights a massive systemic breach of trust.
And that's the real impact here, isn't it? We talk about decentralization all day long, trustless finance, but the reality is so much of the activity still happens on these centralized platforms where we just have to trust that they aren't screwing us.
That is the bitter irony of this whole space. We leave the traditional banking system because we don't trust it. We don't trust the fees, the surveillance, the control. And we end up in a wild west where a startup making $390 million might have weak access controls and employees front-running the customers for personal profit.
Now, I want to be very clear here. No charges have been officially confirmed yet. This is based on an investigation. But the reputational damage.
Oh, it's done. Even if it wasn't strictly illegal, which it almost certainly is, it's incredibly unethical. And it puts regular users at such a huge disadvantage. How can you compete as a retail trader when the platform itself knows your hand before you even play it?
It really reinforces that old, not your keys, not your crypto mantra, but it adds a whole new layer. Not your node, not your data.
Absolutely. If you are trading on a centralized exchange, your data is their asset. Never forget that.
Speaking of rules, playing fair and government oversight, let's move to our third pillar, regulation.
Yeah.
We have been hearing about the Clarity Act practically forever. It's the white whale of the industry.
And Paul Barron's analysis this week suggests we might finally be catching it. Polymarket odds for the Clarity Act passing have jumped to around 70%. The market really thinks this is happening.
Okay, so on the surface, clarity sounds great. We want to know the rules. We want to stop the endless lawsuits. So what's the catch? Because there is always a catch.
The catch is inside the framework, specifically something being called the Genius Act framework. It sounds smart, but the analysis suggests there is a massive poison pill buried in the text regarding stablecoins.
Let me guess. Is it about the yields?
You got it. The proposal likely bans yields on stablecoins entirely.
Banning yields. Explain what that actually means for the average user listening to this.
Okay, so right now on various DeFi protocols or even some exchanges, you can hold USDC or another stablecoin and earn, say, 5 to 10% APY. It's just interest.
Which is often way better than what you get at a traditional bank.
Much better. But this act would essentially make that illegal for compliant platforms. So those interest-style rewards just disappear.
Wait. If I can't get 4 or 5% on my stablecoins on-chain, but my bank is offering me 4% in a high-yield savings account, why would I keep my money in crypto?
You wouldn't. You'd move your money back to the bank, and that is exactly the point. This legislation seems explicitly designed to hand power back to the traditional banking sector. It completely removes the competitive advantage of DeFi.
That is a massive shift. It creates a very clear winner and a loser.
Right. Coinbase, for example, might get their regulatory clarity, which is great for their stock price and institutional onboarding. They get a moat. But they lose that massive chunk of revenue they make from stablecoin yields. And the DeFi ecosystem loses its liquidity.
It feels like the regulators are saying, okay, you can have your crypto, but you cannot be your own bank.
Correct. It's shifting the narrative from crypto is a new alternative financial system to crypto is just another asset class that lives inside the old banking system. It's totally neutering the disruptive potential.
And we are seeing this crackdown play out in the physical world too.
Right.
It's not just high-level legislation in Washington. Look at what's happening in Minnesota right now.
Yeah, this is incredibly aggressive. Lawmakers there are introducing a bill to ban crypto kiosks, Bitcoin ATMs entirely.
Banning them completely, not just regulating them.
A total ban. The argument is elder fraud. They claim too many scams are funneling money through these machines and grandmothers are getting fleeced.
Which, to be fair, is a legitimate problem. We just saw that headline about the U.S. recently seizing $580 million from Chinese scam networks. These pig butchering scams are horrific.
It is a massive problem. No one denies that. But the solution they are proposing is to cut off access entirely. It is a total sledgehammer approach.
And for the ATMs that do survive in other states, we're hearing about 72-hour holds now.
Yes, 72-hour holds on transactions and much stricter KYC rules.
So the days of just walking up to a machine, putting in some cash, and getting Bitcoin instantly and anonymously, those days are dead.
They are dying fast. We are moving from the Wild West to a very bank-aligned environment. We are getting the safety, like seizing that scam money, but we are losing all the decentralized perks, like the easy access and the high yields.
It really feels like the industry is growing up, but it's becoming kind of boring in the process. It's becoming corporate.
Boring, centralized, and monitored. That is the trade-off for mass adoption.
Before we wrap up, I do want to touch on that corporate side of things.
Yeah.
Because while the regulators are squeezing, the companies are pivoting. And one story really stood out to me. Block, Jack Dorsey's company.
This was a shocker. Block cut 40% of its workforce. That is nearly 4,000 jobs.
And the reason wasn't we're broke. The reason was a strategic pivot.
AI first. That's the new mantra over there.
AI first.
Yep. They are pivoting the entire strategy to focus on efficiency and AI integration. And look at the market reaction. Shares jumped 20%.
This goes right back to what we said at the very beginning about mindshare. The market does not want crypto companies right now. It wants AI companies.
Exactly. Investors are rewarding efficiency. They're rewarding the AI narrative. It just reinforces that the narrative the hype has moved away from pure crypto. Crypto is now seen as legacy tech in the eyes of some of these growth investors.
Ouch. Legacy tech, that stings. But I want to end this segment on a slightly positive note because utility isn't dead. We saw the news about MetaMask and MasterCard.
This is actually a really useful product. It's a self-custodial debit card.
Break that down for us. Self-custodial.
It means you keep your keys. The funds aren't sitting on an exchange like Coinbase or Axiom. They're sitting in your own MetaMask wallet. But you can swipe the card at a grocery store, and it converts instantly to pay the merchant.
And you get cash back on top of that.
3% cash back in MUSD.
See, this is what I've been waiting for. While trading is choppy and the regulations are getting incredibly tight, the actual utility being able to spend my crypto without handing it over to a centralized exchange that might be betting against me that is quietly getting much better.
It is. It's the boring progress that actually matters long term. Speculation is down, but utility is slowly creeping up. That's the real signal through all this noise.
So what does this all mean for you? We've covered a lot of ground today. Let's try to summarize this deep dive.
Sure.
Point number one, the market. We're in a midterm year. Do not be fooled by a March rally.
Right. If we see 75K next week, remember the history. It's likely a trap before a quiet, choppy spring. Don't chase the hype. Protect your capital.
Point number two, trust. The Axiom scandal shows us that God mode is very real.
Be extremely wary of centralized platforms. If they can see your cards, they might be playing against you. Diversify where you hold your assets.
And point number three, the rules. Regulation is coming via the Clarity Act, but it might kill the golden goose of stablecoin yields.
The government wants crypto to look like a bank. If you want yield, you might have to look harder or take on way more risk because the easy, risk-free DeFi yields are being targeted.
So here's the question I want to leave you with today, and it's a big one.
Go for it.
If stablecoins lose their yield, and if crypto platforms become just as regulated, monitored, and safe as your local bank branch, does crypto lose its soul? Or is this just the inevitable price we have to pay to get the other 7 billion people on board?
That is the multi-trillion-dollar question. Are we here to replace the banks or just become their digital backend?
Something to chew on over the weekend while you watch those charts. Stay curious, stay cautious, and we will catch you in the next deep dive.
Take care, everyone.